Magnificent Seven. How does the 493 look in terms of earnings?
Yeah, so I think this is still very much a concentration story, or at least that's the way we look at it. So we are, as I said, we're overweight U.S. equities. We've been positive on risk in this environment, but it's entirely based on the view that the AI, what we call a mega force, the AI mega force, is very powerful playing out, and we believe in that. So it's concentrated. That's what drives the market. I don't think we have a strong conviction on things necessarily broadening out. And when you see these quarters of earnings season like we've just gone through, there is momentum building up in the earnings expectation that comes out. So I think you want to be a bit careful in extrapolating too much. I guess we shave some of these optimism to some extent, but very much believe on the concentrated story here on the AI, which will morph into something else beyond the Magnificent Seven. But it's not a broad-based macro story lifting all boats at the same time.
What about foreign stocks? I mean, I heard the argument on the MLive blog, Bloomberg's MLive blog made this morning, I think, that it's a great time to hedge against risk because we're in this Goldilocks environment, but you're going to see growth really more abroad than the kind of concentrated U.S. win story that we've seen lately.
Yeah, so I think, within the DM world, we are pretty excited about Japan. And I think that at this juncture, exactly, I mean, we believe in AI in the U.S., but diversification is important in this environment, particularly because we think this is an intrinsically more volatile environment. And Japan is pretty interesting in that context. On its own, I think has a very, bullish story that is with a central bank, unlike any other G7 central banks, that's going to be supportive of the market, in our view, for the quarters to come. And it has a micro kind of governance story that is happening as well. So Japan stands out and is attractive. And beyond that, I think, when you look on the relative valuation basis or just on valuation basis, EM stands out as well, the EM emerging markets. And when you think about tactically, but also more on a 5-year horizon, where valuations matter more, I think that starts to build to an interesting case. So yeah, I think there is now a building case for diversifying away from within DM away from the U.S. maybe to some extent, even though U.S. is attractive, and away from DM to EM.
Jean, great to get some time with you. Thanks so much for joining us. Jean Bovin of the BlackRock Investment Institute. Coming up, price-conscious consumers flock to Walmart.
I think the real story here is actually below the top line, though. We started for the first time in a long time really strong EBIT dollar growth ahead of sales growth. So starting to leverage in the P&L is really something that the long-only community has been really waiting to see for Walmart. So a really impressive print and probably was a pretty tough quarter for retail.
Good for Walmart. The shares hit a record high. We're breaking down the numbers when we come back. This is Bloomberg.
I think the real story here is actually below the top line, though. We started for the first time in a long time really strong EBIT dollar growth ahead of sales growth. So starting to leverage in the P&L is really something that the long-only community has been really waiting to see for Walmart. So a really impressive print and probably was a pretty tough quarter for retail in the first quarter. And we'll get more results in the next couple of weeks, but we're pretty happy with the numbers.
Walmart benefiting from a more cost-conscious consumer, and I think online sales as well. Pretty amazing. Walmart shares hitting a record high on better than expected results, with upper income households driving the gains. Joining us now to discuss is Evercore's Greg Mellick. He has an outperform rating and a $67 price target on the stock. Greg, I think it's a fascinating story, especially for me, the juxtaposition with Amazon, because, you know, pre-pandemic, Amazon was a cheap place to shop, and I have a very cost-conscious wife. Now, Amazon's prices have been floating higher, and she's started to look at Walmart online, which I always think of Walmart as a place you walk into and hang out in. Is that a huge part of the same-store sales growth that we've seen?
It's a big part of it. And I would say, and even Amazon recognizes this, the U.S. consumer is extremely focused on value. And so whether it's Amazon trying to get more products to people faster, Walmart is doing exactly the same thing. And they're really leaning into their strengths, which have always been that strong value, and now layering in convenience and speed of delivery. And that's bringing new customers to them, and customers they had before coming more frequently, shopping categories that maybe they haven't before at Walmart. So they're sort of winning on three fronts, and that's why it's one of our top names and has been this year.
Abigail Doolittle was pointing out earlier that, you know, sequentially they had a change in the average ticket price, but if you look year over year, it's zero. How do they do that when inflation is so much higher?
Yeah, average basket, that 3.9 comp is particularly impressive when you consider that it's all traffic. And that's positive traffic on traffic a year ago that was up, I think, 2.5%, 3%. So that, to me, is the core underpinning of Walmart. It's you're getting more customers coming more frequently. You know, what inflation is going to be what it is. And they're doing as good a job as they can is trying to suck that out of the system. So overall inflation, and the same SKU inflation in the basket, they said was just 40 bips in the quarter. So that's a couple hundred bips below overall U.S. CPI. So Walmart's doing their part to try and squash inflation. But at the end of the day, there's only so much you can do. But they're as a result, their strong value proposition is just winning more customers.
In terms of the consumer, I mean, it's great if you can get consumers to move down, I guess. But ultimately, you want growth in all of the segments. Can they do that? Can they keep doing that?
I think you can. I think it's not the key of the Walmart story, and to me why it's changed so much in the past 12 to 18 months, is it's no longer about just getting trade down or like people that have to go to Walmart. They're people that want to go to Walmart. It's having 400 million SKUs available through third party on Marketplace. It's getting Walmart Plus memberships to grow. It's getting people to sign up for Sam's Club. Sam's Club, again, you showed the numbers there before, but that was also a comp that was about 100 bips better than we thought. So they're using technology and their strong, historic, low-cost, everyday proposition to bring convenience and speed to consumers. And that's resonating with all income groups.
I'm zooming through your bio on the Bloomberg here, Greg, and looking at the stocks that you cover. I don't see Amazon here. Do you think of the two as direct competitors? Would you choose one over the other?
Well, my partner on it, Mark Mahaney, our internet analyst, we agree that it's a good, Amazon remains a winner. We've got an outperform on it. In our top 5 portfolio, though, I would say that we run across retail. We don't have Amazon in it, even though we think it has nice upside. We think the risk reward on Walmart here is frankly better. At least that's my opinion. And I think it's not an either or. I mean, both combined now, Amazon is up to about 10% U.S. market share of retail, gross market value, and Walmart's about the same. So we could be sitting here 3, 4, 5 years from now talking about, wow, how did we just miss that Amazon and Walmart went from a combined 20% share of U.S. retail to 25 or 26%.
All right.
So to me, it's not an either or. They're both showing that if you put together good prices, great assortment, and faster delivery and speed to help the consumer. That resonates with everybody.
All right, great to get some time with you, Greg. Thanks so much for joining us. Greg Mellick there over at Evercore ISI. Let's get some breaking news now. For that, we go back over to Abigail Doolittle. Abby?
Indeed, Matt. We do have the shares of UBS trading down about 1.4% amid the headline, the breaking news that they are, UBS, considering a U.S. CEO role for Rob Karofsky, who is currently their head of their investment bank. This is to compete more so with some of the other big banks on the wealth management side where there are annuity-like returns. We don't know that this will happen yet, but UBS is considering a U.S. CEO role for Rob Karofsky. It would be a big strategic revamp.
Got it. Abby, thanks very much. This is Bloomberg. Here's your trading diary. Fed Vice Chair Michael Barr testifying before the Senate. That's at the top of the hour. More Fed speak throughout the day with Harker and Mester on deck. And the J.P. Morgan Global Markets Conference continues in France. We'll have interviews out of that for you. Finally, we round out the week with Richemont earnings. We'll see how many expensive watches rich people continue to buy. This is Bloomberg.
We're 30 minutes into the U.S. trading day on this Thursday, May 16th. Here are the top stories we're following. Walmart sales surge as the big box retailers continues to attract consumers, particularly from upper income households. Shares soar, taking Walmart's market cap to $500 billion. It's a different story, though, for Deere, with the machinery maker cutting its profit outlook as demand from farmers slows. We'll discuss what it says about the agricultural industry. And green shoots for Cisco. Chief Financial Officer Scott Herron, he joins in an exclusive interview after the company delivered an upbeat forecast for sales and profit. That conversation coming up in just a bit. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets at the moment, and it's quiet at all-time highs. Of course, we broke to those levels on both the S&P 500 and the NASDAQ 100 yesterday. Of course, we're still hovering around there, but you can see that we're taking a little bit of a breather. The S&P 500 only up by about 0.1%. It's the same story if you take a look at the NASDAQ 100 too. Your big tech benchmark currently higher by about 0.1% or so. But when you're at an all-time high, maybe it's not worth complaining. Meanwhile, you take a look at the bond market here. We are seeing a little bit of a sell-off. You can see that yields on the 10-year currently higher by about 3 basis points, but we're well below where we have been, with the 10-year currently trading at 4.36%. But let's get back to these earnings, because sales at Walmart surging as wealthy shoppers flock to the retailer. The company posting first quarter sales growth along with a better than expected full year outlook. Customers prioritizing staples over those big discretionary purchases. Andrea Felstead of Bloomberg Opinion joins us now. And Andrea, is this a trade down that we're seeing boosting Walmart?
Yes, it is. I mean, Walmart's been one of the big beneficiaries from that surge we had in food prices, consumers being squeezed. So shoppers that, may have shopped in more upmarket supermarkets are turning to Walmart for the value that they're really known for.
And I guess with that in mind, it's probably no surprise that you do see that move towards staples. It's interesting. You take a look at the average ticket. It was flat, but it was the number of transactions that rose. People really just not going for those higher priced items necessarily.
That's right. I mean, this has been a story of the past few years. As we have to spend more of our incomes on the things we need, there's less left over for the things we simply want. The other thing is that food price inflation bolsters the value of sales, and so when that comes down or moderates, supermarkets have to sell more sort of loaves of bread, tins of beans to get the same value of sales. So it was positive that the transactions were up.
And so this, of course, is good news for Walmart. It feels like Walmart can make money in almost any environment. Right now, it's making money from the trade down. I have to imagine, though, that's painful for other parts of the industry, though, Andrea.
I would imagine it is. That what they've talked about is doing a better job on fresh food, doing a better job on general merchandise, fashion, home furnishings. And I was listening to the call thinking the latter is not going to be terribly good news for Target, which has lots of those upper income customers, and they come in for essentials, but they also buy its cut price fashion. So if Walmart's turning its incredible scale on that market, not great for Target, which is trying to turn around its fortunes.
All right, Andrea, really appreciate your time on these blockbuster earnings from Walmart. That, of course, is Andrea Felstead of Bloomberg Opinion. And let's turn now to the broader markets, broaden out this conversation, because joining me now is Mark Spellman. He is Alpine Saxon Wood's CEO, on set with me. It's good to see you again, Mark.
Good morning.
Let's talk about what we've learned about the consumer in the past week, because, of course, we have the Walmart earnings showing that trade down. We got retail sales that were a big goose egg, which I think surprised a lot of people. How are you thinking about the strength of the U.S. consumer right now?
It's definitely weakening a little bit, but I think you have to, there's a difference between going negative and the rate of change on the upside. And even though it seems like ancient history, the pandemic, I think, still has an impact on these numbers. In so many groups, so many stores had huge, massive 20% plus type of top line things. that has to reverse itself or at least normalize. I think you're definitely in more of that normalizing area right now. But when you look at consumer credit, for instance, which is something I think is a good way to look at how the consumer is doing, the vast majority of consumers are in still very good shape, but there is some weakness. There's some delinquency rises on the bottom end for sure when you see credit card companies on the subprime side of things, definitely seeing hikes in those numbers. Again, keeping it, the math here, yes, it's going up, but from a historical basis, it's actually still pretty low to kind of normal, but it's definitely off the lows.
Yeah, no, it's important to consider that, we're talking about rate of change here. When you think about absolute levels, it's a different conversation. How does that translate into how you're viewing the stock market right now? Of course, we're at all-time highs. It feels like the rate of change in terms of the jumps that we're making, that slowed down a little bit, but we're at all-time highs. Does that maybe normalizing consumer give you any pause?
A little bit, and there's a couple of pieces to that puzzle. For instance, just from a technical standpoint, I think the move in the market yesterday was very positive. You took out highs and on a lot of volume. From a technical standpoint, you can't ask for much more if you were just looking at charts. And then that top seven has really, the Magnificent Seven has kind of calmed down. I think it's the broadening out, which we have seen, which is something we've been looking for a couple months, is going to continue. That's very healthy for the market. We like to say that 2024 is the year of the Magnificent 493. The evidence I can point to there is the industrial group has done very well this year, was beating QQQ and tech for a while. Tech has caught up recently, but they're both up about 10% year to date. That's very healthy for the market when you see broader groups going up.
And I have to ask, what's driving that? Because it's interesting. You mentioned industrials. That's been an on and off outperformer. Utilities are now being talked about as an AI play.
Yeah.
What's driving that broadening out that you see?
Earnings is still the key. Cost cuts have been put in place. So you're seeing some good leverage on the top line. I think there is an element of rate cuts there. If you're looking to cut rates, or you think rates are going to get cut, industrials is a go-to kind of group, historically speaking. So I think that's kind of the backbone there. We think you might get one rate cut this year, but I don't think the Fed's in any rush to cut rates.
Yeah.
Nothing seems to be broken at the moment, and I guess that's the worry that if they don't cut rates, something might break. But right now, we're in the probably one camp.
Mm-hmm. Well, I guess I wonder, how much do certain areas of this market really need rate cuts? Because, you focus specifically on the small caps, and you think about some of the maturities that are facing the Russell 2000 index, for example, when it comes to the balance sheets. And that's been pointed to as a reason to me to maybe be a little bit bearish on small caps. So weigh, again, earnings and what we see in the economic environment with the fact that we have bond payments coming up.
Yeah, I think that's, while I appreciate that sentiment, I think it's too broad of a stroke. You have to dig down into on a company-by-company basis. If you're heavily levered with a lot of maturities, yeah, that's bad. It's definitely bad. But not every company is like that, and those are the ones that we try to find at Alpine Sachs and Woods to invest for our clients.
And we're going to get to some of those names after the break. But I am curious, we should talk about memes, obviously. It's been quite a week. It's only been 4 days. We were up straight up for 2 days. Now it seems like we've been going straight down. Just putting it all together, what do you make of what we're seeing? Because I thought this wasn't supposed to happen after you hike 500 basis points.
I was surprised. I will say I was surprised. And I personally don't think it's a good development as far as the health of the market is concerned. It does show an ebullience that, a bubbling over. And historically speaking, it has been close to tops. Like as you said, 4 days isn't making a trend yet, so we'll see how it goes. But generally speaking, we'll be keeping our eye on it. We don't think that's a great development as far as the market's concerned.
Just quickly, do you think the Fed cares? Do you think Jerome Powell is watching this?
No, I think he cares about PCE, and that's it.
Okay, PCE, not AMC.
Exactly.
So hang tight for just a couple
GME
minutes.
Either.
No GME, just PCE.
Right.
Let's take a look at what's moving underneath the markets right now. We're going to do that with Bloomberg's Emily Griffeo. Emily, what do you got?
Well, a big turnaround in Under Armour. That stock was hitting the lowest levels since 2010, just after the bell, and it's actually now paring those losses. The earnings for this quarter for the retailer were relatively strong and in line, but actually their guidance going forward was much lower than estimates. They see adjusted EPS for 2025 at 18 cents to 21 cents. That was versus estimates of 59 cents. And it also sees operating income 50 million to 70 million versus estimates of 352 million, Katie. So a big miss on the forward guidance for the retailer, but the investors don't seem to mind as that stock is paring those losses. Under Armour is also approving a restructuring plan to strengthen and support the company's financial and operational efficiencies. So perhaps investors are catching on to that plan and liking that plan from Under Armour this morning.
So there you go. And it's a good reminder that it is still earnings season,
yes,
of course. So that's the story with Under Armour. Tell me what's going on with Chubb and Berkshire Hathaway.
So Berkshire Hathaway had been building a stake in a financial company for several months, but the market didn't know what company it was until last night in a filing. It was revealed that it was Chubb. Warren Buffett is building a $6.7 billion stake in the insurer, and analysts across the street are largely positive about this investment. Bloomberg Intelligence said this is a classic Warren Buffett position. Evercore said it's actually a slight positive signal that Berkshire Hathaway is building such a large investment in this point in the cycle. And then Vital Knowledge said that Chubb is a leader in an industry that Buffett knows very well. So that stock is up, paring the gains just a little bit, but still up over 4%, Katie.
Yeah, 4%, not bad. I would certainly take it. Bring it home. Tell me about JD.com.
So U.S. listed shares of the e-commerce, Chinese e-commerce retailer JD.com up now about 3% just this morning. They beat expectations. They were also in an earnings season. And this is even amid a slowdown in the Chinese economy. And you compare this to their competitor Alibaba, which posted earnings earlier this week, which were a little bit weaker. For JD.com, 7% rise in revenue, and that came amid a move to slash prices, particularly in their consumer electronics business.
All right, Bloomberg's Emily Griffeo, great stuff. Appreciate the roundup. Coming up, Deere cutting its profit outlook as slowing farm demand hits the tractor maker. Details next. This is Bloomberg. Well, Deere cutting its annual profit outlook as demand for farm equipment slows. U.S. farmers are poised to see the biggest hit to their income since 2006, and that decline, of course, puts Deere under pressure. Chris Cellino of Bloomberg Intelligence joins us now with more details, and I feel like we saw this from some of their rivals as well. So is this a Deere problem, or is this really an industry problem?
You're right. I mean, it's an industry problem. We expected Deere to cut their outlook just because, you know, their primary competitors in the U.S., C&H and AGCO, also lowered their outlook this quarter. But this was more of a haircut than we anticipated. They lowered their net income guidance about 8%. To about $7 billion this year, which would imply earnings are going to be somewhere north of $25 a share in 2024, or about 8% below the street. And really, the reduction's been driven by, one, deteriorating global ag markets, and two, a need to manage rising inventory levels as that demand starts to pull back. So you're going to see Deere meaningfully underproduce demand here in the back half of the year. I think the question now becomes, is this enough of a cut to destock the channel?
Well, that's kind of what I'm curious about. I mean, do you anticipate that we could see more cuts, or do you trust that Deere has the management know-how to really manage those inventory levels that are piling up?
Yeah, I think it ultimately comes down to what does the retail demand look like as we exit the year and head into next year. You know, farmers are incredibly challenged right now. We've seen a little bit of stabilization maybe these last 3 months on crop prices, but by and large, they're down year to date. They're down significantly versus the prior year. Farmers have higher production costs. Interest rates are still quite elevated. So farm income is going to be down 26% this year. And on top of that, you have generally weaker farmer sentiment. You have uncertainty ahead of the election. And they've gone out and bought a lot of equipment over the last 3 years. So the age of that fleet has come down pretty precipitously. So we really kind of struggle to see a near-term catalyst for a reacceleration in demand. And historically speaking, these downturns really they don't last 1 year. So we're looking at for a little bit more of a prolonged downturn this cycle.
All right, a potential prolonged downturn there. Deere shares currently off by about 3.5%. Chris Cellino of Bloomberg Intelligence, thank you so much. Let's turn back now to these broader markets with Mark Spellman of Alpine Saxon Woods. And we were talking a little bit in the break about valuations. And of course, you take a look at the broad S&P 500 with that really massive weighting to the Magnificent Seven. And it tells one story, but then you take a look at the equal weight version, it tells a different story. So how are you feeling about valuations?
Actually, surprisingly okay. The equal weighted index, excuse me, you know, you have about a 16 PE, which is very much in the normalized range. It's not an extended level. So that gives us, you know, a lot of confidence that there's stocks out there to be bought, and you don't have to just buy you know, what is working. There's going to be, you know, we have seen year to date a catch-up trade as far as the broadening out is concerned, which we were discussing earlier. I think that's going to continue because there is some reasonable valuations out there. Companies are making a decent amount of money. Free cash flow is at record highs. There's a lot of reasons to continue to be bullish here.
Well, let's talk about some of your highest convictions here, because, like, to your point, there are stocks to buy. I know that last time we spoke, you mentioned Google, for example. Google has been on quite a tear. What would you say the thesis on Google is right now after it's up, what, 24% in 3 months?
It hasn't changed a heck of a lot, honestly, and it's still fairly reasonably priced. You know, EV to cash flow is about 19 times. This is a company that's going to grow its top line 15%. That's a hard number to look for, or it's an easy number to look for, is a hard number to find. And when you compare it to other names, say, for instance, Apple is trading at a higher valuation and its top line is probably going to be 3 or 4%. So we think the backdrop for Google, there's a presidential election, they get under scrutiny. AI is, you know, a bit of a worry for Google. I think the worry is Google makes most of its money, an enormous amount of money and operating margin on search. Is OpenAI going to come out with its own search engine that will displace some Google? And Google's got such big share, there's no, but, you know, they have nothing share to lose when it comes to
true.
that. So that's the worry. But we think it's fairly priced. Obviously we like the 24% ago a little bit more, but we continue to own it, and we continue to actually buy it. Excuse me.
And so, I mean, with Google and some of these other tech names, such as Microsoft, for example, I mean, they are just spending loads and loads of money on AI. And I'm curious, as an investor, what kind of signal do you take from that? Is that a bullish sign that they're investing in their future, or do you wish that maybe they would allocate that money to other areas?
I think they have to be involved on the cutting edge, and how it depends on how they're applying the AI to their core competencies. And you are seeing companies that are doing that. There's adjacent industries which we think from an AI standpoint will benefit. When you look at the data centers, which we've talked about in the past, a company like Equinix, a data center company, the wind at the back of the data centers is just tremendous, and it's a very long runway for them. Rents are going up double digit, capacity is low. The biggest worry from a data center standpoint in our mind is where they're going to get the power from. And that's the biggest issue. But if you were ever to solve that, I mean, the growth for that industry will be huge for a long time, but we still like that stock right here.
And I mean, you continue down that thesis, then we get talking about utilities, again, being an AI play. But I agree on data centers. We were actually talking to a CRE investor a few weeks ago who said that it's the hottest asset class right now. So you're seeing it really across industries. But speaking of AI, we have to talk about NVIDIA. Reporting next week, you mentioned it 3 months ago, is maybe a company that you would avoid staring into earnings. Is that still the case?
Yeah, I think, yes. The short answer is yes. I think we're getting there. I do want to see the print, although the competitors and the customers of NVIDIA that have reported kind of indicate NVIDIA's quarter is going to be okay. We're going to wait to see what the print looks like, though.
And does that view extend to semiconductors broadly, to the chips broadly, or is it just NVIDIA here?
I think it's just NVIDIA, because the growth rates have been so gaudy on NVIDIA, 30, 40, and 100% sometimes. I think that's what we really want to look at. The other semiconductor companies have sort of more normalized double-digit stuff, and I think the level of error there is probably less.
All right, good place to leave it, of course, as we look ahead to NVIDIA earnings coming up on May 22nd. Mark, it's great to see you again. Really appreciate your time on this Thursday. Our thanks to Mark Spellman of Alpine Saxon Woods. Now, still ahead, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon Middle East and Africa for the stories, newsmakers, and insights from this exciting region. Now weekdays, only on Bloomberg.
All right, it's time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, Microsoft reportedly asking hundreds of China-based AI staff to relocate outside the country, of course, as tensions between Washington and Beijing mount. Staff were said to be offered the opportunity to transfer to the U.S., Ireland, Australia, or New Zealand. Next up, we have EasyJet reporting a larger than expected loss in the first half. The budget European airline also announcing that its CEO will step down in January. He joined Bloomberg Television earlier.
I've been with the company now for 7 years. We've gone through a lot of, positive changes and transformation, and this has allowed the board to do a thorough search. And I'm so delighted that they chosen to appoint Kenton, who's the current CFO of the company, as CEO. He'll be a great leader for this as well.
And finally, we have Canada Goose reporting better than expected Q4 results. The pricey puffer jacket, it's seeing stronger demand in the U.S. and China after months of a slowdown. Of course, we're heading right into summer, so that's interesting. But nevertheless, the Canadian company also announcing a partnership with actress and climate activist Jane Fonda. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Let's take a quick check of these markets right now. We're just about an hour into the U.S. trading day. Things are perking up a little bit. It's still quiet, but the S&P 500 building on gains right now, currently up about 0.2%. We're above 5,300. We're at an all-time high. Feels pretty good. You take a look at the NASDAQ 100. Similar story there, also up 0.2% on those big tech names. Of course, we do have some heavyweights reporting next week. I'm talking about NVIDIA. That, of course, will be very consequential for that grouping of companies. And then a quick check on the bond market. Another quiet day after some fireworks. The 10-year yield currently higher by about 1 basis point. Now coming up, Cisco Systems boosting its full-year forecast as businesses begin to spend on computer networks again. Scott Herron, the company's CFO, he joins us next. This is Bloomberg. And we are watching shares of Cisco Systems this morning. The stock, it's actually down right now despite reporting a pickup in orders in the last quarter, a sign that customers are investing in their computer networks again. Bloomberg's Abigail Doolittle has more.
And it's been a bit of a finicky morning for the stock, Katie, because earlier Cisco Systems, the shares were higher in the pre-market, now down about 1%. Anything seems possible by the end of the day, especially given the fact that analysts are saying that the guide, which some are viewing as disappointing, may just be conservative. First, though, in terms of the quarter, as you mentioned, they beat both the top and the bottom line estimates. One issue, though, here is seeing that the revenue growth over the last couple of quarters down after some growth, so some fluctuations here as well. Is that enterprise customer in place, or what's driving this this little bit of a hiccup here? As for the guide, if we take a look at what some folks are saying is disappointing, but again, Morgan Stanley and Citi both saying it's conservative. Revenue, $53 billion, the estimate of $53.6 billion, a small miss in terms of the earnings as well, and then the adjusted earnings is actually slightly higher. But Morgan Stanley saying that this is conservative and that the June 5th Analyst Day, June 4th Analyst Day, that will be a next driver. Citi also saying that this is conservative. And then finally, Katie, if we take a look at Cisco relative to one of its benchmarks, right now underperforming. Actually, this is a different chart than what I was looking for. This is, but relative to the S&P 500 Telecom Index, if you can just imagine, they're basically neck and neck, about flat over the last year or so.
All right, Bloomberg's Abigail Doolittle, thank you so much. And let's keep the conversation going now, because I'm pleased to say we're joined by Cisco CFO Scott Herren. Scott, it's great to see you in person.
Thanks for having me, Katie. It's great to be here.
I'm going to turn that question right to you when it comes to the guide, because you gave a prediction for fiscal 2025 indicating that revenue growth will be in the mid-single-digit % range. A lot of people out there saying it's conservative. So is it conservative?
What I wanted to do, so this was our fiscal third quarter that we announced, and normally I wouldn't guide fiscal 25 until we get to the fourth quarter earnings call. But, we just acquired Splunk, so that big news for us is we acquired Splunk, we got it closed mid-quarter, and I think the analysts are all trying to adjust now to what does the combined company look like. So what I wanted to do is kind of get ahead of that with fiscal 25, and without doing a fulsome guide, just get enough information out there so that they could narrow down their expectations for fiscal 25. Is it conservative? I think it's a first view of where that's going. I think the encouraging thing for us is we've worked through the supply chain disruptions that we had that caused us to build up a huge backlog. And then we're able to clear, as we got the components in, we're able to clear that backlog. Revenue spiked, and now we're having to compare to those compare points. So the year-on-years are a little bit difficult to actually discern what's happening in the underlying business. We spent some time trying to unpack that for investors yesterday, and we'll do some more of that with the buy side later. So first view, but really just trying to give them enough insight so that the models would start to converge on what we think is the right set of numbers.
So it sounds like you're not saying no, but making the point that it's very early. I mean, 2025, who knows what will happen. But let's talk a little bit more about inventory. You make the point that it feels like you've turned a corner when it comes to a lot of those supply chain disruptions. And what does that say about corporate spending? A lot of people looked at this report and said, there's green shoots there. There's a bit of an uptick. If that's the case, where is that coming from? What kind of customers are we seeing that demand from?
What's really interesting for us, and of course we've got Splunk added in for just half a quarter. So if you net that out and look at what the core business on an apples to apples basis looks like, actually, orders were flat overall, which is an improvement from where it's been, as customers have been really trying to implement the huge amount of product that we shipped out to them in 3 consecutive quarters. We see that ending. We see them getting through implementing all of the product that we ship to them by about the end of this fiscal quarter, which for us will end at the end of July. And as that happens, we're already starting to see demand return and product orders flat. I think encouragingly within that overall flat, growth in security orders, growth in collaboration orders, but most importantly, growth in data center networking orders, which has been a headwind for some time, and growth in campus switching. And I think the campus switching one surprised a lot of people that we're seeing growth there with the sense that, there's more vacant office space than there's ever been. How can campus switching be growing? So I think it's an encouraging sign.
So some tailwinds there. And it took me 3 questions, but we have to talk about AI because, of course, a detail that caught a lot of people's eyes was the fact that you have about $1 billion on AI infrastructure orders in sight. And I guess my question there is that for a particular line of business? Where would that spending actually be taking place within Cisco?
Yeah, it's a great question. That's not a new data point. We put that out there. It's in the back end. So if you think of how these AI models get trained and then get used, which is called inferencing, it's in the back end. So it's networking and optics in the back end. A lot of that going to the big, large public clouds that you'd expect, and the tier 2 AI infrastructure build out is what drives that.
And can you talk to us a little bit about sort of the timing here when investors are thinking about when these orders convert to sales and growth, when we will actually see that? What kind of time frame?
You know, no one's more anxious to see that happen than I am at this point, right? And I think there's a lot of things that have to fall into place for those orders for the line of sight that we have. And by the way, that line of sight is driven by, in each case, especially with the large web scalers, we build a bespoke product for them. They give us the specs and they're all doing something slightly different. We build a product, it goes through a pretty rigorous testing process, and then you get designed in for a use case. So we know what those use cases are, and as those start to build out, as the infrastructure starts to build out for those, that's when we'll start to see the line of sight turn into actual orders and revenue that come in the door. I think that's going to be more weighted toward the second half of our fiscal 25.
Okay, fiscal 25, we're back there again.
Yeah.
I do want to talk about who that spend is coming from, because there's a lot of discussion about the hyperscalers. You think about AWS, Microsoft, Googles of the world. They haven't big users of Cisco gear, but when it comes to the AI spend, do you see that changing?
Yeah, for sure. And I think you have to go back to when they first started building out the big public cloud, compute. The truth is at Cisco, we missed that initial build out a decade and a half ago. We missed that and learned a lot, actually recovered in that space and built some pretty good traction with the large public clouds just in the compute and storage space. As they start to build out AI infrastructure, it's a different architecture in the back end, and we've gotten ahead of it this time. And we've gotten to the point where we're designed into dozens of their use cases, their specific use cases. So it'll come from the top 4 to 6 public infrastructure cloud providers that you've talked about.
And I do also want to talk about costs, because it seems like analysts, they were a little surprised by the magnitude of the expenses that you're taking on from that Splunk acquisition and some other things. I know that you had announced headcount reductions this past February, but looking forward with that focus on cost, do you think that there's more of those actions coming?
I don't think so, and I'll tell you why. The motivation behind the acquisition of Splunk for us, it fits so perfectly into our own security strategy that we'd laid out, and really building a security platform that will be, of course, incorporate all the Cisco products, but third-party products as well, because security will continue to have some element of best of breed in it, so we're going to have to connect to that. So their SIM product fits perfectly within our security strategy. We got not just great technology with Splunk, we got some great leaders with Splunk. And I think one of the other exciting announcements from yesterday's earnings call is we announced Gary Steele, who was the CEO at Splunk, continuing to drive the Splunk integration, but also taking on a new role as the president of go-to-market worldwide for Cisco. And Gary's a guy I've known for a long time. I was on his board at his previous company. He's a great operator. He's a guy that I know well, trust, and he's a great operator, and I think that I'm excited about seeing what he'll do. We have a world-class sales team, and in the hands of Gary, I'm excited to see where that goes.
So Gary Steele staying on, it seems like that is a happy marriage, to say the least. But while we're on the topic of Splunk, before I let you go, I have to ask, what are your thoughts on large deals going forward? Is that something that you're still keeping an eye out, or are you going to sort of stay on the sidelines for a bit?
Large deals on the acquisition front. You know, we continue to generate a fair amount of cash. And one of the interesting things about the Splunk transaction, because the hard work the Splunk team did before we acquired it, it's cash flow accretive to us in the very first year. So it doesn't affect our capital return. And so, you know, if you look at our priorities for capital allocation, first and foremost, it's to drive the growth of the company, and some of that will be inorganic. But it's also, of course, to support the dividend, which we continue to increase on an annual basis, buy back shares at about a $5 billion a year rate. And then if there's excess cash beyond that, that's where we'd look to do something else.
So my two takeaways, okay, maybe the guide for 2025 is a little conservative, we'll see, and of course keep an eye out maybe for some inorganic growth opportunities. Scott, really appreciate your time on what I know is a very busy morning. Our thanks, of course, to Scott Herren of Cisco. Meanwhile, take a look at the Dow Jones topping 40,000 for the first time. Abigail Doolittle is back here with what's driving that strength.
Yeah, and I just happened to put the Dow on the board today, Katie, in anticipation of that possibility before it happened. Now back below 40,000, but again, as you mentioned, above that level for the first time ever. And a small gain up about 0.2%. You can see the S&P 500 and the NASDAQ 100 up about a similar amount. So we have record highs for the three major indexes and a second day of record highs for both the S&P 500 and the NASDAQ. For the Russell 2000, though, not so much. If we take a look at the small cap index, we are going to see here that index is, in fact, lower on the day. That is being driven, of course, by some of the meme weakness. The Russell 2000 down, not so much, down about 0.3%, but after that huge surge for GameStop, AMC, and Virgin Galactic on Roaring Kitty, talking, or not even talking, showing a meme of the possibility of getting interested again in GameStop, that big surge, and now we've had 2 days of pullbacks. In terms of what this could mean for the Russell 2000, are we going to see an all-time high there? Well below that level, I think 10, 12% below that level. But if we go into the Bloomberg terminal and if we take a look at the Russell 2000 here, we are going to see it hitting up against resistance. This is similar, but in a different way to the other indexes. These are not all-time highs. These are recent highs. But the point is we have selling resistance, similar to what we had last spring and summer. Selling resistance at that time, the RSI, or momentum indicator, headed down, and we have a decline. So the question is, are we going to see a break above resistance for all these indexes? Right now, each of the indexes trying, but is the range, you can see this range here for the Russell 2000 pretty well, as its RSI is just kind of sagging there a little bit. Will the breakout be real, or are we going to see some consolidation back down? Stay tuned. Never a dull day, Katie.
Never a dull day. Some big questions there. We'll, of course, see how that one shakes out. Our thanks to Bloomberg's Abigail Doolittle. Now, coming up, the U.S. appetite for EVs. We'll talk to Elizabeth Creer. She is J.D. Power VP of Electric Vehicle Practices, next on Wall Street Week. This is Bloomberg. right, it's time now for Wall Street Week, and today we're looking at the impact of President Biden's Chinese tariffs. Wall Street Week's David Weston, he spoke with Elizabeth Krier. She is J.D. Power Vice President for EV Practice about the U.S. appetite for cheaper EVs from China.
Well, the auto industry is a global industry, as you know, and all competition needs to be taken seriously. At the end of the day, the consumer decides. Consumers want choices, new technology, and value. The U.S. EV capacity has now exceeded consumer demand for EVs, and we're starting to see conquest sales through price deals and incentives. Competition is expected to continue to increase, with 10 more EVs hitting the U.S. market this year, particularly in the midsize SUV and truck segments. SUV and truck sales make up over 80% of the U.S. market. In contrast, small cars make up less than 1% of the U.S. market. The $11,000 China Seagull would be in this small car segment. The Chevrolet Bolt, also a small car, under $20,000 with federal tax incentives, during its peak sold less than 0.5% of industry monthly retail sales. I'm not an expert in geopolitical decision making, but consumers are looking for lower cost vehicles within the segments of their preference. There is a void in the marketplace, and this is similar to the late 1980s, early 1990s, when Hyundai and Kia came to the U.S. market looking to fill the void. Whether low-cost EVs are first offered by domestic brands, Asian brands, European brands, or Chinese brands, we'll have to wait and see, but there is a market for them.
But as you just said, Elizabeth, within the segment they're interested in, it sounds like the segment that the Seagull's in, the really small, really inexpensive one, that's not potentially that much of a threat to U.S. automakers.
That's correct. That's a very small segment.
And
1%. But that doesn't mean that they can't bring their same low-cost initiatives to other segments. But when you ask the question, is there an appetite for super low-cost EVs, that's the type of vehicle that would fit within that category.
So you've been studying consumers and their reactions to electric vehicles. You actually had a report out at the end of March. And as I read that, it isn't so much the price point as the charging stations. People really are invoking that as a reason to be hesitant.
Absolutely. We survey over 2,000 new vehicle shoppers every month to gauge their interest in EVs. And when we look at the top reasons for rejection, those who say, I am not interested in an EV, we see lack of charging station availability as the top reason for rejection, but purchase price as the second. So that's where EV education comes into play. There is a learning curve to owning an EV, figuring out where to charge, how frequent to charge, how much to charge. And although for many, charging may not truly be an issue in terms of availability, but perception is reality. And charging is simply too much of an unknown for them. And same goes for price and understanding the total cost of ownership of owning an EV. Often the savings with the EV incentives and operating costs and maintenance for that matter often offset that initial price. But again, this needs to be explained to the average shopper. So infrastructure, price, education, all very important.
Well, it's interesting listening to Elizabeth. It sounds like education is a key component here because it's something new, obviously, for most of us. We're used to internal combustion engine cars. Now we're going to EVs. And some of it is, how long does it take to charge? How much do I charge it? By the way, I hear a lot of things about if it's really cold outside, does it lose the charge faster? Is there an opportunity here, actually, for U.S. automakers to educate us as consumers so we'll be more comfortable with this?
Absolutely. I said perception is reality. And for the consumer to learn how to deal with their new EV, they need to understand what it means to home charge, what it needs to charge on a daily basis. Maybe the solution is you charge at work every day as opposed to at home. Or when you're on a road trip, that's a different scenario altogether. Road trip folks today in a nice vehicle, they're used to going to the gas station and filling up. But when you're on a road trip with an EV, maybe a better solution is every time you stop, because you're stopping anyway, you just charge because you can. So there really is an education, and customers need to feel comfortable, and to feel comfortable understanding charging and the visibility of charging is incredibly important.
That was Elizabeth Krier of J.D. Power with David Weston. This is Bloomberg. JP Morgan CEO Jamie Dimon, he says that he's still more worried about inflation rather than the markets. And of course, we just saw the Dow making history, hitting the 40,000 mark rather. Dimon sat down, of course, with Bloomberg's Francine Lacroix from the JP Morgan Annual Global Markets Conference in Paris.
I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I could point a lot of times in history where that was true, and the next year it wasn't true, and so. We'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest
rates? I'm a little more worried about it. I mean, we've had very big fiscal deficits. And, I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes next time around, the next move?
I really don't pay that much attention to that. The Fed will have to follow the data. And I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance. My view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems, and so the future isn't predictable like that. So I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of '72 and the collapse of '74. The healthy markets of '80, the collapse of '82. The '87 market crashed, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of this. We can serve all our clients regardless.
But what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn and maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
And that was JP Morgan CEO Jamie Dimon with Bloomberg's Francine Lacroix earlier. Coming up, we have Bloomberg Technology, Seema Shah from Principal Asset Management. She joins next. That does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, full earnings coverage ahead. We've got Cisco. It's sliding as analysts stub its outlook conservative. We'll hear from the CFO.
Plus, we dig into Walmart's results as the commerce giant posts a big jump in its online business.
And we'll be sitting down with the CEO of hot AI search startup Perplexity to discuss growing competition in the search space and a new set of board advisors. But first, let's check in on the markets because NASDAQ, new record high. Dow above 40,000. S&P, new record. Global stocks lift higher. We still get that economic data that, for now, gives us comfort that the U.S. economy is still strong, but cooling. From an inflationary perspective, will the Fed be able to cut? We've got more Fed speak coming today. Yields on the 10-year, basically flat, up about 1 basis point, maybe selling off a little bit more at the front of the curve. But this is a risk-on day. Let's move on and see whether it's flowing into the world of crypto as well, because we had seen a rally. We're actually down some 0.6% on the last couple of days, well, on at least this day, intraday basis. Still holding about a $65,000 level as it stands, though. So it's not all risk-on end, but is in the benchmarks. What have you got on the individual stocks?
Well, look, earnings all around the world are going to be a really big story for us. You know, those classic technology names like Walmart, for example, up 6%. But the story there is a really big surge in growth on its online business, as you said. We'll go to Jaewon Kang, our reporter in Chicago, to talk about that. Cisco's now down 2%. It was much higher in after hours last night. And at first, its outlook was seen as strong guidance, and now we wake up and it's seen as conservative. We are going to hear from the CFO, and Bloomberg's Ian King is going to join us on set to break down the networking gear company and also transition to software. And then we go to China, and later in the program you're going to talk about some of these Chinese names, right? JD.com showing top line growth 7%, really strong cost discipline boosting profit. But we're learning who the winners and losers are in China right now with the Chinese consumer in the e-commerce context. Alibaba's up 7%, having fallen on its kind of weaker sales. Why? Michael Berry, Cyan Asset Management. JD.com number 1, Alibaba number 2, top holding for them. Maybe we can talk a little bit about that as well.
Yeah, we're going to dig into that a little bit later in the show. And the here and the now is to dig in investor sentiment more broadly. We can do that across geographies, across industry groups, but really to tackle these record highs. We're with Principal Asset Management Chief Global Strategist Seema Shah joining us. And look, I mean, game on today from a macro perspective, and will it carry on into the tech outperformance, do you think?
Hi, great to be on with you. Look, it's a good risk on day. I think there's fundamental reasons for that. You know, of course, there's a discussion about rate cuts coming back onto the agenda. But I think more fundamentally, we can see that from the economic data, it's slowing. But we're not talking about a weak economy as yet, at least. So this is still a fundamentally strong economy, which means that earnings should be fairly solid as we go through the year. And that should translate into a broadening of the rally, which is why we're seeing so many of the indices reach record highs.
Seema, hey, it's Ed in San Francisco. I've been looking at all the index level energy so far year to date, right? And you look at the NASDAQ 100, S&P 500. I can't believe we showed the Dow Jones Industrial Average at the top of this program today. But I think what I'm trying to find out is if there's any commonality in the direction of the market, and strip out the Mag 7, because I know that that's top of mind for so many people. Is there something in common for this market, or is it still dominated by our view of those single technology names?
So I think those single tech names, they are clearly still dominating the market. They're driving a lot, but what you have seen from the most recent earnings season is that this good performance is spreading out to other parts of the economy. Other sectors have done pretty well. So if that can be maintained, and particularly if you do actually start adding in those rate cuts towards the latter part of the year, that will help the story, particularly for certain segments of the market. I mean, even if you're just thinking about small caps, they need those rate cuts. But overall, this is a broad, good story. We still probably need to see a little bit more evidence in order to secure that perspective. But at least for now, the evidence that is coming in suggests that this isn't just a year for the Mag 7, but it's going to be a year for the broad equity market.
What about the valuations of, well, they're fewer than 7 now when they're magnificent, but more broadly, let's call it chip stocks, let's call it the winning formula of Nvidia, of, well, Alphabet, even Apple getting some lift again now. Are those valuations out of whack?
It's interesting. I was traveling across the US last week, and I was with investors everywhere, and that was a question that still keeps coming up: is, do we think of this as overvalued, and is it time for a correction? So we would definitely push back on that. Yes, it's a little bit frothy, but do we make comparisons to the dot-com bubble? Absolutely not. These earnings are somewhat believable, maybe a little bit frothy, as I said. But there's actually something fundamental in those valuations, so it doesn't really concern us. Inevitably, with this kind of market, when there's so much good news priced in, there's always going to be risk of a bit of a pullback. But we look at the tech story as a long-term play, and from a long-term play, we still it's still one of our favoured areas of the market.
You talked about the good news that's priced in, Seema. I don't want to bring the mood down, but something we've been talking a lot about recently on the show is the relationship between the US and China, whether it's constructive or otherwise. Is that a headwind you're factoring in right now, particularly when you look at the technology sector?
So inevitably, it's something that we do need to consider, especially when you're going into the presidential election, where China is going to be top of the news as we get closer and closer to that point. So it is something we consider, but I think it's very much on a single stock name basis, because there's some which are going to be particularly exposed and others which are not so much. The good news from a China standpoint, though, is that from the most recent data that we're seeing come in, there does seem like it's a bit of a cyclical upturn. It's nothing to rave on about, but something at least to lift at least expectations. If that is carried through, then certainly for a lot of those other those bigger multinational tech companies which have got so much exposure to China, it does suggest that they're a little bit less at risk than we would have considered. But certainly the geopolitics is something we always have to watch. But it's not yet at that point where it's changing our perspective on positivity about the sector.
I like that we go global, because look, it's not just US stocks that have done particularly well of late. Japanese stocks on a tear. European stocks, 600 been in at a record as well. Where are you liking other geographies right now?
Yeah, and it's a great question, because at the moment, I mean, at least for the last couple of weeks, what we've been challenged with in the market is that although I think a lot of people continue to believe in US exceptionalism, they have been confounded by the fact that the rate cut debate continues. We're not very sure about where that's going. When you think about the growth story, you're starting to see economic downside surprises in the US. And then, of course, there's evaluations. So then this is probably a good time to start thinking outside of the US. And there are some good stories. So even if you think about Europe, which is the perennial disappointment, but now you're seeing that we know what the ECB is going to do. We have, I think, pretty much good confidence that there's going to be cuts in June and then thereafter. We know that we're starting to see a cyclical economic upside surprise, not an acceleration, but at least we're seeing some good news come through, and then valuations more attractive. So if you look across Europe, that's fairly good news. And even in China, as I said, given where sentiment was, you couldn't get much worse than that. And now with the economic data seeing some signs of brightness, that is looking like a more attractive part of the market too.
Seema, you're a regular on Bloomberg Television. You're a regular here on Bloomberg Technology. Away from the markets, I wanted to ask you about how you're using AI at work or at home. We're going to be talking later about AI-driven search. What have you been up to in the world of AI?
But look, I mean, I think any company out there has to be embracing AI and trying to figure out where they can use it in any parts of work and home. So from a work perspective, of course, trying to adopt AI into our models, trying to analyze the companies from a single sector, single stock perspective, that is going to be the easiest way to try and do full analysis and get a full, complete level of information. So that is something that we're trying to bring into work. I have small children. AI is the stuff that they talk about at school as well. So you can see that this is everywhere. It's not just dominated by the finance news.
Principal Asset Management Chief Global Strategist Seema Shah. AI everything all the time in markets. What more can you ask for on Bloomberg Technology? Coming up on the show, we're going to hear from the Cisco CFO, Scott Herren, as the company slides and its outlook is being seen as conservative. That's coming up next. Stick with us because we'll be right back. This is Bloomberg Technology.
Got to talk Cisco because it's been quite the volatile trade. After hours and in today's trading, we're now off by 1.7%, moving lower. Well, despite the forecast actually showing a return of customer spending, of networking gear. Analysts dubbing the outlook perhaps a little conservative. Look, Bloomberg got the chance to discuss all of the results earlier with Cisco CFO Scott Herren. Take a listen.
So this was our fiscal third quarter that we announced, and normally I wouldn't guide fiscal 25 until we get to the fourth quarter earnings call. But, we just acquired Splunk, so that big news for us is we acquired Splunk, we got it closed mid-quarter, and I think the analysts are all trying to adjust now to what does the combined company look like. So what I wanted to do is kind of get ahead of that with fiscal 25, and without doing a fulsome guide, just get enough information out there so that they could narrow down their expectations for fiscal 25. Is it conservative? I think it's a first view of where that's going. I think the encouraging thing for us is we've worked through the supply chain disruptions that we had that caused us to build up a huge backlog. And then we're able to clear, as we got the components in, we're able to clear that backlog. Revenue spiked, and now we're having to compare to those compare points. So the year-on-years are a little bit difficult to actually discern what's happening in the underlying business. We spent some time trying to unpack that for investors yesterday, and we'll do some more of that with the buy side later. So first view, but really just trying to give them enough insight so that the models would start to converge on what we think is the right set of numbers.
So it sounds like you're not saying no, but making the point that it's very early. I mean, 2025, who knows what will happen. But let's talk a little bit more about inventory. You make the point that it feels like you've turned a corner when it comes to a lot of those supply chain disruptions. And what does that say about corporate spending? A lot of people looked at this report and said, there's green shoots there. There's a bit of an uptick. If that's the case, where is that coming from? What kind of customers are we seeing that demand from?
What's really interesting for us, and of course we've got Splunk added in for just half a quarter. So if you net that out and look at what the core business, apples to apples basis looks like, actually, orders were flat overall, which is an improvement from where it's been, as customers have been really trying to implement the huge amount of product that we shipped out to them in 3 consecutive quarters. We see that ending. We see them getting through implementing all of the product that we ship to them by about the end of this fiscal quarter, which for us will end at the end of July. And as that happens, we're already starting to see demand return and product orders flat. I think encouragingly within that overall flat, growth in security orders, growth in collaboration orders, but most importantly, growth in data center networking orders, which has been a headwind for some time, and growth in campus switching. And I think the campus switching one surprised a lot of people that we're seeing growth there with the sense that, there's more vacant office space than there's ever been. How can campus switching be growing? So I think it's an encouraging sign.
So some tailwinds there. And it took me 3 questions, but we have to talk about AI because, of course, detail that caught a lot of people's eyes was the fact that you have about $1 billion on AI infrastructure orders in sight. And I guess my question there is that for a particular line of business? Where would that spending actually be taking place within Cisco?
Yeah, it's a great question. That's not a new data point. We put that out there. It's in the back end. So if you think of how these AI models get trained and then get used, which is called inferencing, it's in the back end. So it's networking and optics in the back end. A lot of that going to the big, large public clouds that you'd expect, and the tier 2 AI infrastructure build out is what drives that.
Cisco CFO Scott Herren giving, frankly, a classic class on being a CFO for a technology company. Let's get some clarity on Cisco, its technology and its earnings, and bring in Bloomberg's Ian King. There was a lot of CFO speak in that. Unpick it for us and explain the quarter that's just gone.
Yeah, I think the best way to view it is through the lens of what happened with the share price. We had an initial spike yesterday.
In after hours, right?
Exactly, in after hours trading, and today we're sort of down moderately, a little bit more sober. What really happened, and Scott kind of alluded to that, was the expectation for orders was that they would be down possibly as much as 10%, maybe even more in the quarter that they just reported. Came in as kind of okay, maybe up slightly when you include this new acquisition. So there was like things aren't as bad as we had feared kind of reaction that happened in the after hours. Then when we go through the numbers and listen to the call, we've seen a reaction this morning which is more like, yeah, okay, it's okay, but bearing in mind they've just done this massive acquisition, maybe they're not getting quite the kick from that.
Yeah, I mean, we have to take Splunk into consideration here, and there's going to be new role of president, for example, Ian. But what about some of the other partnerships, not actual M&A, but, you know, they had this big fanfare of an NVIDIA deal and partnership. Has that bringing in any much-needed revenue streams?
Well, that is still in the early days, so we don't really know. But, you know, back to the conversation that was had with Scott and the big question of this $1 billion of AI-related orders. Obviously, Cisco wants to go to the party too. At the moment, though, and there were a lot of questions on the call yesterday. Well, what exactly do you mean by $1 billion? Who's giving you these orders? How sure are you that these are real orders and not just an aspirational goal? And there was a lot of to and fro with the leadership team about, you know, what that really means and whether this is real. And really, the bottom line is that investors aren't quite yet ready to let Cisco into that AI party.
Ian, you broke a story literally as we started the show and before you walked on set about Ampere, the chip company, teaming up with Qualcomm to make AI technology, AI infrastructure. I didn't know that Qualcomm was in that line of business. I do now. Give us the details.
Yeah, I mean, what's going on there is Ampere, who we had at our tech conference last year, they're an ARM server chip company trying to get into all of the big hyperscalers. They're teaming up with Qualcomm to bring in this accelerator to try to basically bring a cheaper alternative to the kind of thing that NVIDIA is selling for many tens of thousands of dollars. We'll see how well that goes. We'll see how well that performs.
I mean, we sat with Renee James, both you and I, individually at various points throughout that event last week, Ian, and she's a breath of fresh air in many ways to the area of computing and the startup side of things. But it looks like there's kind of a trifecta going on. They can't just do it alone. They've got to be working where there's Supermicro's involved, Supermicrocomputer alongside Qualcomm, alongside Ampere. But the key refrain coming from everyone is energy, right? Efficiency here.
Yeah, as you point out, Renee is pretty fired up about this, and she's making a point which many agree, which is we cannot carry on like this. The cost of AI in terms of power, in terms of money, is just too great right now. We need technology answers to that problem. We need more efficient chips. We need cheaper chips. And she's trying to offer that, her company as a solution to that problem.
Well, certainly managing to come out to the market with a combination offering at the moment. Ian, it's brilliant that you got to break it for us. Thank you, Bloomberg's Ian King. Meanwhile, coming up, we're going to be talking about Walmart out with its earnings results. And look, we're going to focus on the e-commerce side because they're playing a big role. 4 billion deliveries in one day, in same day over the last year. Meanwhile, Ubisoft, let's just talk gaming for a moment because it's ugly over there in Europe. We're down by 12.8%, most that we've seen this company's fall in 16 months. There's a video game publisher over in France warning that bookings in the first fiscal quarter will be lower than analysts had estimated. You tweeted this one out, Ed. Well, you posted it earlier. This is Bloomberg Technology.